All right, let's talk about what happened in November, because a shockwave just ripped through the crypto market. Bitcoin's price took this sudden, really deep dive that honestly it caught even the most seasoned traders completely off guard. So what in the world was going on? Let's break it all down. The scale of this drop was just staggering. We're talking about a nearly 25% plunge, with prices crashing from over $126,000 down to about $81,000. To put that in perspective, that's basically $1 trillion wipeout across the entire crypto market. And it happened in just a few weeks. Wild. And that really brings us to the big question, the whole reason we're doing this explainer. Was this just another classic case of crypto being crypto? The usual volatility. Or are we actually witnessing a fundamental shift in how the Bitcoin market really operates now? Let's dig in and investigate. Okay, so to really understand what happened, we've got to follow the money. So who is selling? Let's take a look at the key players who actually kicked off this whole billion-dollar plunge in the first place. The on-chain data, the stuff recorded right on the blockchain, it's crystal clear on this one. The selling pressure didn't start with a bunch of panicked retail investors. Nope. The first domino was actually pushed by some of the biggest, most experienced players in the entire game. So basically, you've got these whales, these massive wallets holding thousands and thousands of Bitcoin. And they started methodically taking profits after that big rally we saw in October. This wasn't some kind of panic sell. It was a really calculated move. But in doing so, they thinned out the market's support, leaving it super vulnerable to a shock. So once the price started to drop, that's when the smaller retail wallets did start to sell, which of course added to the pressure. But here's where a really fascinating dynamic popped up. This group of mid-sized holders, we're talking wallets with anywhere from 10 to 1,000 Bitcoin, they actually saw this as a buying opportunity. They stepped in to buy the dip, but their buying power just wasn't enough to turn the tide. And this right here is exactly how a simple price correction spiraled into a full-blown crash. The futures market acted like a massive amplifier. As prices dipped, traders who had borrowed money to bet on prices going up got margin called. That means their broker basically said, hey, you need to cover your losses right now. This forced them to sell their Bitcoin, which pushed the price down even more, triggering the next wave of forced selling. It was this brutal domino effect that just sent Bitcoin tumbling. Now, if the story ended right there, it would just be another crypto crash, But here's the plot twist. There's this fascinating new theory from ProCap CIO Jeff Park, and it suggests that the fundamental engine that drives Bitcoin's price might be changing for good. So here's how this new theory works. For years, the market has followed this 4-year halving cycle, right? A programmed cut in new Bitcoin supply would kick off a big bull run. But Park argues that's the old Bitcoin. The new driver? He believes it's all about the behavior of institutional investors buying through ETFs, and that's creating a totally new, shorter 2-year cycle. Now, to really get this, you have to understand this key concept, calendar year P&L. See, professional fund managers, they're judged on their performance at the end of the year, December 31st. This creates this intense pressure. If you're up big, you might be tempted to sell a risky asset like Bitcoin just to lock in your gains for the year. And if you're down, you might cut your losses to avoid an even worse annual report. For them, it's really about job security. So, Park breaks this down by imagining 3 different groups of fund managers who bought Bitcoin ETFs. First, you've got cohort 1. They bought in early, they're up a massive 100%, and they're seriously tempted to sell and lock in those huge gains. Then there's cohort 2. They bought in later, they're actually down right now, and they are under immense pressure to see a huge rally just to meet their targets. And finally, cohort 3 is kind of right on track, but they're facing that classic dilemma. Do I sell now and secure the win, or do I risk it for even more? You can see how each group is feeling a very, very different kind of pressure. And this is the real gut punch of the whole theory. For you or me, a flat price is, well, it's neutral. But for a fund manager who's paying fees and chasing a 30% annual return target, a flat price is a failure. It's underperformance that can trigger selling all on its own. The game has totally changed. So given this new landscape and this massive crash, where do we stand? Is the worst over? Well, right now, the data is pointing in 2 completely different directions. It's confusing. So first up, let's look at the bullish case, which comes from K33 Research. They're basically arguing that this sell-off was an emotional overreaction, a sentiment-driven overshoot. They see this major disconnect from the fundamentals and believe that at these prices,
Bitcoin is now a strong relative buy for any long-term investor.
And they've got data to back this up. For instance, look at the trading volume on the day of the crash. It was the fourth highest of the entire year. K3 sees this huge spike as a sign of sell-off saturation, that key moment of capitulation where the buyers finally absorb all the selling pressure, potentially forming a market bottom.
But, and this is a big but, we have to come back to those whales again. The on-chain analysts over at CryptoQuant are raising a major caution flag.
During that dip, a critical battle was playing out. So while some of the largest wallets and those mid-size holders were buying, that key group, the 1,000 to 10,000 Bitcoin whales, they were still selling or distributing. CryptoQuant's warning is pretty simple. As long as this powerful group is still selling, any kind of recovery is going to be built on a very, very shaky foundation. And all of this brings us to the final act of our story. The Bitcoin market right now is really defined by this central conflict, a huge battle for control between two powerful and opposing forces.
So the question everyone wants an answer to is what happens next? Which one of these forces is actually going to win out? It really all boils down to this. The bear case is that the original whales just keep cashing out, putting a ceiling on any real rally. The bull case is that this new army of dip buyers and fresh institutional money is strong enough to absorb all that selling and forge a new bottom. It's a classic standoff.
And that leaves us with one final, kind of provocative thought to chew on. Maybe what we're watching here isn't just bulls versus bears. Maybe it's something bigger, a fundamental battle for control of Bitcoin's destiny between its original crypto-native old guard and the powerful new money of institutional finance. Who wins that fight? Well, that could define the next era for the entire market.